Hey everyone, welcome back to Corporate Decoder, the place where we break down these massive corporate documents. And today, we're diving into Serina Therapeutics Incorporated's latest filings. You know, when you see a report with so many dates and numbers, it really makes you wonder what they might be hiding, or perhaps what they're really excited about. Let's jump right into it. Serina Therapeutics is a company focused on developing treatments for neurological diseases, and they've just put out their quarterly report. We're going to look at their financial health, their big risks, and what the future might hold, all in plain English. First off, let's look at their financial situation as of the 30th of September 2025. They've got total assets of about $12.4 million. That might sound like a lot, but when you look at their liabilities, which are essentially their debts and obligations, they're sitting at almost $10.8 million. That means they have a pretty thin margin between what they own and what they owe. Digging a bit deeper into their liabilities, their current liabilities, meaning what they owe in the short term, jumped significantly to almost $8.8 million by September 2025, compared to just $2.4 million at the end of 2024. That is a huge jump, and a big chunk of that is due to things like warrant liability and a new convertible note. This tells us they're taking on new financial obligations, which can be good for growth but also carries risk. Now this is interesting. By September 2025, they have about $5 million in Series A convertible preferred stock. This is a special type of stock that can be converted into regular common stock. The fact that it has a significant liquidation preference means these preferred stockholders get paid back before common stockholders if the company were to sell off assets. This hints at how they're financing their operations, bringing in money from investors by offering them these preferred terms. Looking at their equity section, the accumulated deficit is a big number. By September 2025, it is over $60 million. This is the total of all their past losses minus any profits. It shows that for their entire history, they've spent more money than they've made. This is common for early-stage biotech companies, but it highlights their reliance on continuous funding. Let's look at their performance over time. For the 3 months ending the 30th of September 2025, their total revenues were zero. That is right, no reported revenue for that quarter. Their total operating expenses for that same period were almost $6.4 million. That means they spent over $6 million without making any money in that quarter. This is why that accumulated deficit is so large. For the 9 months ending the 30th of September 2025, their total revenues were a mere $130,000. Again, not a lot, but their operating expenses during those 9 months were a massive $17.9 million. So they're spending a lot more than they're bringing in as expected for a clinical stage company. This is the core challenge they face: funding their development until they can bring a product to market. A huge chunk of that spending goes into research and development. For the 9 months ending September 2025, they spent nearly $9.8 million on R&D. That is a significant increase from the $5.1 million they spent in the same period in 2024. This increase is driven by things like more outsourced research, hiring more people, and costs associated with product development. It shows they are actively pushing their product candidates forward. Their general and administrative expenses, which cover things like salaries for non-research staff, legal fees, and administrative costs, were about $8.2 million for the first 9 months of 2025. This is also up from $6.5 million in the same period in 2024. This rise seems to be due to things like stock-based compensation for new hires and costs related to being a public company. Now, let's talk about something that can really swing their reported income. The change in fair value of warrants. In the 9 months of 2025, this actually resulted in a gain of over $1 million. But in the previous year, 2024, it was a loss reflected in their financials of over $10 million. Warrants are essentially options to buy stock, and their value can go up and down a lot, which can make their net income look very lumpy from quarter to quarter. When we look at their cash flow, their net cash used in operating activities for the 9 months of 2025 was $11.9 million. This is similar to the $12.5 million they used in the same period of 2024. This shows they are consistently burning through cash just to keep the lights on and fund their ongoing research. But they are bringing in money from financing activities. For the 9 months of 2025, they generated about $16.9 million from financing activities. This came from things like issuing stock, drawing down on their new convertible note, and selling shares through their At-The Market program. This shows they are actively raising capital to keep their operations going. Something to note is the non-controlling interest, which by September 2025 is showing them owing about $166,000. This often relates to reporting for subsidiaries or partial ownerships, indicating that a portion of the company's financial results isn't fully controlled by Serina's main shareholders. Now let's talk about the risks. they have a section on forward-looking statements, which is basically a disclaimer saying that their future predictions might not come true. They mention risks like the unpredictable nature of drug development and regulatory approvals, and the need for more funding. This is a standard part of these reports, but it is a good reminder that their stated goals might not be achieved. A really important point is that on the 3rd of November 2025, they announced that the FDA put a clinical hold on their lead drug candidate, SER-252. The FDA needs more information about a common ingredient in the drug's formulation. This is a significant hurdle. It doesn't relate to the main drug itself, but it means they can't move forward with their clinical trials until this is sorted out. This is a major setback and directly impacts their timeline and costs. This also touches on a critical risk factor. The FDA approval process is lengthy, unpredictable, and expensive. Delays like this can have a huge impact. And if you look at their overall picture, they've never sold a product. They don't expect to for several years. If ever, this means their entire business model relies on successfully navigating the complex and costly drug development process, getting regulatory approval, and then somehow convincing people to buy their product, all while managing substantial financial losses and the constant need for more money. Overall, Serina Therapeutics Incorporated, or SER as their stock symbol goes, is a company heavily reliant on external funding to fuel its research and development efforts. They are in the very early stages with their drug candidates, and the recent clinical hold on SER-252 from the FDA is a significant concern. While they are actively raising capital, their substantial accumulated deficit and the ongoing operational losses paint a picture of a company facing considerable financial pressure and execution risk. Their ability to overcome these hurdles, particularly the FDA's concerns, and secure further funding, will be critical for their survival and future success. Alright, that is our breakdown of Serina Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord community linked in the description below for more discussions. Thanks for watching, see you next time.